Hello, M&A scientists. Welcome to the M&A Science Podcast, where we learn from the best in M&A to uncover proven techniques for enterprise value creation. If you're interested in learning more about how to optimize your M&A practice or want to get involved with our community of forward-thinking M&A practitioners, visit mascience.com. Subscribe to our free weekly newsletter for the latest industry trends and insightful content and community events. And if you want to keep up with us on the go, head over to LinkedIn and follow M&A Science. I'm your host, Kison Patel, CEO and founder of M&A Science. Joining me today is Baljit Singh, who has led corporate development and strategy at companies such as Nielsen and Avaya. In addition, he's made investments in early stage companies through a corporate venture fund. Today, we're going to talk about how to balance corporate strategy and M&A. Baljit, how are you doing today?
I'm doing very well, and thanks for having me.
Thanks for coming. We're doing this in person, live in Midtown Manhattan at our podcast studio that's sponsored by Valuation Research Corporation.
This is great.
Let's kick things off with a little bit about your background.
Absolutely. So if you don't mind, I'll take a couple of pit stops back. So I started my career at Verizon as an engineer. That's the first time when the company went through its transformation through merger with GTE and then acquisition of MCI. I got the first taste of deal making. And as a result, after that, I went to the business school. Coming out of business school, I did banking at UBS and Citi, advising industrial and telecom clients. After the 2009, I transitioned into corporate development. So I went to a company called Telecommunication Systems, which was a mid-sized public company. And because it was a small company, in addition to M&A, I did treasury, investor relations, and some of the FP&A and controllership work. My next stop was Avaya. I had a great experience there, but the most transformational experience was that the company went through restructuring and then exited with a public offering. Similarly, at Nielsen, two bigger transactions was we divested off half of our business to Advent Capital, which was the non-media CPG business. And then about a year back, the company went private. So I would say that I was fortunate enough throughout this whole journey to have been at the place where these companies were either growing or going through their transformation, and in the process ended up working with some really phenomenal people and leaders.
You got quite the ride, seeing it from all angles, from the early days of as an engineer and how it gets impacted to the more extreme of a large take private.
Yeah, it wasn't by design. I just happened to be at the right place and a lot of times.
It seems like a common thread with a lot of the corporate M&A story. Let's set the stage by identifying the difference between corporate strategy and M&A strategy.
Yeah, I mean, this is one of those things where it's important to get the nomenclature right? So let's start with the corporate strategy. Corporate strategy is your top-level strategy, which sets the direction for the company as to where you want to be in the long term. So, for example, your corporate strategy could be price or cost-centric. It could be product differentiation-centric. So I'll give you a couple of examples. So for price-centric, perfect example is Walmart. Everyday low prices. That's what they advertise. And in addition to that, they have made them really a tech leader by providing this omni-channel access where a person, whether they go into the store or online or mobile, they get the same experience, same price. So that's how they differentiate themselves. Example for product differentiation, no better example than Apple. Go back to the days of when you had the iPod, then iPad, iPhone. I mean, the thing amazing about what comes out of that company is it's so easy to use. And I think that's where they differentiated themselves. And I'll go back to a company that I worked for before, Avaya. So their tagline is innovation without disruption. And what that means is all their customers who traditionally were on-premise, they need to be all moved to cloud. How do you do that in a seamless way that does not disrupt them? For that, you have to build capabilities, whether it is people, partners, products. So that's are the examples of what I call as corporate strategy. Now let's look at M&A strategy. M&A strategy very simply is what are the gaps, right, you have in your capabilities. This could be on the product side, it could be on the commercial side. So what are the gaps that you're trying to address? So examples of that, and that defines what your M&A strategy is. So one case could be you're trying to build your scale. This is what happened with a lot of airlines. Continental merged with United and all those airlines combined, right? So that's one. The second is you might be trying to expand into another geography. Uber acquired Careem in Middle East. There are others where, for example, it's a roll-up strategy, and that generally works well in a differentiator, in a very fragmented space, right? You keep buying very similar product, you just build scale, squeeze out the cost, right? Or you could be doing it to enhance your product roadmap, so you buy in technology. Or it could be an acqui-hire case where you just want talent. Now, those address specific gaps, right? The thing that is of most importance is M&A and strategy. They should always support your top-level strategy. Like if you go into a 10K of a company like Google, they actually tell you that acquisitions, investments, JVs, and divestitures, these are all elements that support our top-level strategy, right? So the way I think about it is corporate strategy is at the top. Anyone and everyone in the company should directly or indirectly support it, and M&A execution and the strategy is one element that supports it. I don't know if that was clear for you.
Well, I had a friend that once told me this, that M&A itself isn't a strategy, but it's a tool to use against a strategy.
That's exactly right. The only reason I address the way that is, that's what I've said, it is an element that supports your overall strategy. So you cannot have the word M&A strategy separate from M&A execution. That's why I said it is nothing but finding what the gaps in your capability is. Finding the gaps is essentially telling what the rationale for the deal is. So essentially think about this in very simplistic layman's terms, is the rationale for the deal more than anything more complicated than that. It is the mechanical piece that addresses or supports the top level strategy, corporate strategy. And you're absolutely right. I think that is the way it needs to be looked at.
How do you make sure you get it right? Because I feel like this gets pretty ambiguous, right? All these things, when I talk to practitioners about success of M&A, it all goes back to how well was the strategy defined. And I think there is that element of how well the M&A is defined against that overall corporate strategy. I'm just curious, like, how do you see that in practice, where there is some real clarity there that expands to the other stakeholders in the broader company as you progress on a deal versus when that doesn't happen?
Yeah, so first of all, if the strategy starts with the M&A team, I think that is not true corporate strategy. It actually has to start from a very CEO, CFO, business units, actually. That is the place where it starts with. You should be an active participant in that. Mm-hmm. But outside of that, it cannot be something that takes its roots in M&A, and then you go out and try to sign up other people or bring them aboard, right? So that's absolutely right. So I'll give you my example. I used to report to our chief strategy officer. The chief strategy officer had M&A and corporate development function reporting into him. So his scope and purview was a lot bigger, and he was truly responsible for the strategy, which he looked at me and my team to handle that one component, but he also looked at, how else, like partnership is a huge component, like the strategic partnership is a huge component of that. How do you address that? And also, of all the capital that comes, what is the best places to invest? The prioritization of that, all that is tied to strategy, so that you make sure that you're putting the limited dollars at the right places to advance the cause of the company. So yeah, 100%. It needs to start at the very top, and then you, as an M&A practitioner, has to make sure that what you're doing is not disjointed from that in any way. In fact, you should be an active participant in the framing of that. But that cannot be your sole responsibility.
Can you take me to an example of when you go to actually pitch an opportunity, right? You found this deal and you obviously got to get consensus between executive leaders, board. How do you convey that opportunity with that broad strategy? I mean, is it just reiterating this is what our company strategy is and this is how M&A fits into it, this particular deal fits into it? Like, what's the best way to nail that pitch down?
I think you summarized it well. Always start with that this is our corporate strategy. So corporate strategy, for example, a lot of companies these days, as they're transitioning, is to become more digital, more streaming, those kind of things, right? So that is part of it. Now, if you go out and acquire a company that actually helps you lead in that direction, then you tie it back to that, listen, this is how it supports this component of the corporate strategy. Now, there might be multiple ways to do that. One of the things as, build by a partner, there are multiple avenues to do that, to support the corporate strategy. Assuming the other two options are not viable option in that case, then you say that M&A, bringing the assets or the technology in-house is the best way to do it. But it all has to always tie. So when you say deal rationale, right? So deal rationale eventually has to tie it. Why are you spending very limited and precious dollars, corporate dollars, on something? So absolutely right. It has to, no M&A deal can ever be done in isolation without tying it to the broader company.
Just want to make sure I get clarification, because when I think of corporate strategy, I think there's like a few different defined elements. I may look at where's our position in the market, right? Like for us, we want to be the number one technology provider in the M&A space.
Sure.
Right? SaaS and M&A. The second may be defined around the customer experience. Like we really want to have this unparalleled leadership in terms of the capabilities that we deliver to the customer. And then we have like some revenue. We want to be able to reach $1 billion ARR in 10 years. And when you look at that, there's a few different pillars of a corporate strategy. And then here I'm going back to the M&A opportunity, and I'm trying to not justify, but clarify to the team so that we got some good buy-in and alignment on why we're doing this deal. Is there a certain area of that broader corporate strategy I want to hone my messaging into that would land stronger, or do I bring all those elements together? Like, what is the best way to approach it?
Yeah. So first of all, you need to be more surgical, right? Means you need to tell specifically which specific element of that corporate strategy this particular M&A transaction is addressing. So I'll go with the three examples you mentioned, right? You said one was you want to be the number one player, unparalleled customer support, and the third one that you said was reaching $1 billion of ARR. So the way I see is the first two are ways of getting to the third, right?
Right.
So because you can get to a $1 billion of ARR by buying just revenue, which means, so that I don't consider as the core part of the strategy. That might be your overall corporate goal, which is where to reach it, but that is not strategy. So in that particular case, for example, even the companies I worked, they were very lopsided in the revenue they got from US versus international. A big part of that was how do you diversify so that the risk is low, as well as the growth opportunities that are in the international markets, you are able to avail that, right? So in that particular case, so that's your strategy. So how do you, when you go out and look for a transaction, you look for certain assets and companies in international markets, which are in the purview of what you do. You don't want to just randomly buy something that is not in your core area of expertise, but that's a very simplistic example of how you can support. That's one example that you said is to expand internationally.
That was like partly a trick question, because I wanted to get to the point of where some of these companies are all revenue based, that they're anticipating acquiring revenue to meet some of their target goals. And that's where, does that sort of fall out?
So actually, in a lot of PE-backed portfolio companies, when they're trying to build scale, right? They have this roll-up strategy. But even there is a lot of thought process even in that roll-up, right? They're not randomly just adding revenue. They're saying that this other company we are buying, it absolutely adds revenue, it adds ARR. But it advances what the core area in which we are already working? Or if you have proactively decided, I want to expand the scope of what I do that is fine too. But otherwise, if that's the case, you want to increase the revenue, you can just go and buy a bunch of McDonald's franchises and bring it under your company. You will have a higher revenue, but you are not good at doing that stuff.
Good answer.
So, I mean, there's no good answer to this. Everyone has their own perspective. That's my perspective.
That wasn't bad. I was trying to pull the rug under you. It didn't work. So it was good. Let's talk about capital allocation.
Sure.
Because I'm always curious about this, especially in a larger enterprise, that you're allocating capital towards these M&A opportunities, but then you have different business lines that's competing for CapEx. They have their own departments within it that are competing for CapEx. How does this get sought out?
Yeah, I mean, that is, and I'll bring the concept of M&A into it, right? A lot of it is operational finance, but for any company to grow, they need capital injection, whether it is for R&D, whether it is for sales, or anything in between, right? So let's take an example. There's one company that has 4 business units. At the beginning of the year, they will have their operational plan set, which means each will get their own revenue target, and they will be told how much you can spend to achieve that revenue target. In a sense, it is a simplistic P&L where your contribution EBITDA is how you are measured. For time being, let's ignore the corporate allocations that get slapped on each of these business units, right? So leave that aside. So now, let's assume that there is R&D budget that a particular business leader has been given. If you ask anyone, everyone complains that they don't get enough. I mean, that is, even at the most well-funded companies, there's always desire to have more. But some folks, in a very perverse way, might actually look at M&A as a way to buffer up their R&D capabilities by supporting an acquisition, which is purely tech acquisition, doesn't come with any revenue, so that they can build their R&D muscles. It could be an acqui-hire or something else. So the reason I'm saying it's perverse is because that acquisition is being supported with a very narrow view, not the way precious M&A dollars should be spent. Now, because M&As are very episodic events, right? It's difficult to predict a year in advance that's going to happen. That's not part of the plan you could do. So that's one way. The other thing is, especially in tech companies, software development is the biggest expense, right? So the companies do have an ability to capitalize some of that software expense and move it onto the balance sheet. So by doing that, they reduce their operating expense as it relates to R&D, which means it improves their EBITDA, their contribution EBITDA. Now, did you really improve your profitability, the business the business unit level profitability? No, you just took advantage of how some of the accounting works. So that's why I always say the best antidote for all of these things is you should have a view of a cash-based metric. So if you looked at that business unit purely from a cash flow perspective, you will bring that CapEx expense under, and that you will be looking at the whole expense. Doesn't matter how much of it is OpEx and how much of it is CapEx, right? So that's one way to make sure that there is right amount of accountability and you don't fall for these gimmicks, which makes you artificially look better than you are. And similarly, if you did actually do an M&A transaction and costed you the company money, you could ask some money back from the business unit because you spent some money. And even if you don't want to do that, then increase their top line targets that you got something you need to show in year 2, year 3, year 4, the benefits of this expense, M&A expense that you incurred. So it's just that the discipline and the clear message to the teams that your true profitability is how you're going to be measured, not just on a 1-year basis, but on a multi-year basis.
So there's no here's a clear-cut budget that you have for M&A. They need to rationalize it as those opportunities come up.
Yeah, no, absolutely. Because if there are 4 business units, it doesn't mean that next year each one gets to do one transaction. I mean, that's the very myopic way of looking at it. First of all, you're constraining yourself, and then you're forcing this business unit saying that, oh, I need to do one transaction in my space because I have some budget for it. And that's not the best way to do it. So that's why I think it goes back to the concept of portfolio, like in financial terms. If you have 4 small portfolios and you're trying to optimize them, you can optimize them individually. But when you look at them collectively, that might not be an optimized portfolio because, it's something portfolio A might be doing. It's the same mistake portfolio B might be doing. The best way is to look at collectively, and that's how the M&A dollars should be looked at, is if it's possible that of 4 business units that we're talking about, one doesn't get to do a transaction for 2 years, and that's fine. It should not be something that should be done artificially.
So it's almost like a broader view. You have this
has to be.
There's a business unit level view of, hey, here's my case on why I want to do M&A to grow the business. But there's almost a broader capital allocation of, there's a different size of these business units. What kind of impact is that actually going to make? Because if we got, $5 million and $100 million, and you're going to see a greater impact on the bigger one potentially.
Yeah.
Then you start prioritizing it according to that, and then you may down prioritize the one.
100%. And it goes back to the previous thing we were talking about. You tie it back to the corporate strategy, which is at the corporate level, and not BU strategy, which is at the business level.
Got it. This is why we have a lot of corporate bureaucracy and politics.
It is. It's no different than any other function, right? You have to deal with these things, and as long as you have a clear message of how the performance will be measured, I think it removes a lot of clutter.
PE firms, it all fundamentally goes to IRR. Is there a concept of that in the corporate world?
It does. So I used to. There are different metrics to measure, right? The performance, especially when you're looking at the phase when you're evaluating a company, you projected its financial, and you're like, let's do DCF, let's do multiples. IRR is a good way to do it. IRR is basically, from a pure finance perspective, is the discount rate at which the future value becomes 0, right? So if an IRR clearly has to be significantly higher than the cost of capital for your company. Otherwise, it doesn't make sense. Off the bat, it will be dilutive, right? Pure basic finance, right? So the good thing about IRR is that, it's more, in my view, a more tighter view than DCF. Like DCF, because it has so much of its value tied to very long-term internal value. And if you do things there, who has seen how things are going to be 10 years out? So IRR is actually a pretty good metric. When we look at any of these metrics, none of these are looked at in isolation. That's why we have a football field where you have this, that, and you come up with the most scientific triangulation, and IRR could be a part of that.
So you've got different things to look at, and I was kind of curious, when you look at the performance of an individual business unit, can you hold them accountable to IRR and just have it at that? But then, obviously, some parts of the financial.
I think the easiest way to hold a company or a business unit that has a P&L accountable is just hold them accountable on the things that they have direct control. So revenue, absolutely. All the direct costs, absolutely. You could give them a little bit of wiggle room on the allocations, but those two things that are totally in their control, they cannot blame anyone else for that. and that's why IRR is something. For example, I said that the cost of capital, and there are many business case studies on this, right? So cost of capital is at the corporate level. Okay, so if there are two business units, one has a very stable line of business, the other one has a very high fluctuation business. The high fluctuation business, by definition, should account for the higher IRR. But let's say you go out and you're a public company and you go out and you want to raise funds. If you're going to use your parent company's stature and their stability to squeeze lower interest rate when you're trying to get the funds, you're basically cross-subsidizing that particular business unit compared to others. Means it should be charged, at least internally, on the fluctuations that it has, as opposed to another business unit that is more stable. So the point of all this is that there are direct ways to measure the performance of business units without taking the next step, which is IRR and discount rates and other things into consideration. I'll tell you most of the cases where you do a transaction, and when someone says the transaction fails, the first thing that fails is it couldn't meet the revenue targets. That's the first thing. You would hardly ever see that, oh, the company met the revenue targets, but it came at slightly higher expenses. That is generally in M&A circles and corporate, it would not be considered as a failed transaction because you could squeeze things out. It's much easier to reduce the cost than to increase the revenue. It's right. Because for increasing the revenue, you have to go to a customer who has to write the check to you. To reduce the cost, it's all within your control. You could, take a 10% haircut or 15% haircut or do something else, totally in your control. So that's why I tied back to what's in your control, and those are the metrics you use to measure the performance of a business unit, or something broader than that.
What was the thing you mentioned earlier about some business units could make their books a little funny or have a different picture about OpEx versus CapEx so that they can give a different view about the rationale of doing M&A?
The whole point there was, right, if you're measuring, again, so I'm glad you brought that up. So I just now said that you measure the business units on the things that they control directly, right? Mm-hmm. So in the things that they control directly, what I was saying is, if you're measuring them on purely contribution EBITDA, they say that one way I can reduce the expense by still spending the same amount on R&D, by moving or being more aggressive on quantifying of all my R&D expense, how much is CapEx, right? So there would be, now, just so you know, it's not that the companies can go without any restraints. There are accounting and controllership gates that prevents them from just going crazy. They cannot move everything, right? But when an auditor comes, there's always a little bit of a wiggle room. I used to work, when I was doing controllership work, I used to work with the auditors, and I would put forth my case that why it makes sense to have a certain value, and they have to eventually sign off on it, right, before it gets released. So before I lose my train of thought, it is to go make sure that it's very clear that the things that they control, even when they split between OpEx and CapEx, that they control it, and as a result, they are held responsible for it.
That makes sense. They gotta hold them accountable from
hold them accountable where you prevent any acts that may make them look better than how they actually are. That's the whole thing, and that's why you got to go back to cash being your North Star for most of the things, because it really clears all the clutter. You can see through it, and that's why even in the public sector, a lot of companies who pay dividends are considered highly, because no matter what you do in your SEC filings, when you pay dividend, you have to let the cash leave the company. There is no other way around it. You could do whatever you want to do accounting wise. That's a truth that you have to face, right? So that's why those companies get a lot of respect, and that's why you just saw this in the last 10 days or so. Facebook decided that they're going to start issuing dividends, which is very unheard of for a tech companies. But that's another way to highlight to the broader industry that they can look at you a lot more confidently, as opposed to being a tech company that is very is not as solid.
Delivering your shareholders IRR.
Yeah, no, that's exactly right.
This take private deal. Now we're not going to name any names.
Yeah, no, that's fine. So
now, if you can't put two and two together and figure it out, you're probably not the best M&A scientist out there. But tell me about it. Tell me about the whole thing of this take private, why they happen, because we see it more and more. Big PEs are coming in and just take a whole public company private, and it's fascinating.
Yeah. So I'll start in generic terms first, and then I'll come to the specifics. So when you think about why do a company go private, I can boil it down to two reasons. One is, which is very simple, that the public markets are not valuing you correctly. They don't see your intrinsic value. And there could be a whole lot of factors why that is the case. It could be that you have not as stable earnings every quarter. So it's difficult to predict you. And every time it's difficult to predict you, the public investors, they get nervous. The other is you might have missed one or two earnings cycles, means you came under what the consensus was. And the third could be that you actually play in a sector where the whole sector is under pressure, which has a dampening effect on your stock as well. So that's one thing. But in my view, the second, which is more important, is being a public company means under the quarterly spotlight of earnings and questions from analysts. Now, if you are trying to do something transformative that requires not just one quarter, multiple quarters, maybe many years, where you make the investments upfront and then you reap the benefits later, going private is a good way to come out of that spotlight, make your investment, be focused, put your head down, and then provide something on the other end, and then go public, right? So those are the two main reasons I think why the companies go private. Now let's come back to the sector we're talking about. Media and advertising sector has been undergoing transformation for some time. I think it's the biggest surprise is the rate at which that has been happening. You had the traditional TV before, but everyone is now moving to linear, OTT, digital, right? I mean, this week, I think it was Tuesday, announcement came that Disney, Fox, and Warner, they decided to launch a super app that will carry their sports content that they have with the leagues. It was actually such a big announcement that the leagues almost got off guard. And this is very monumental because today, if you look at your traditional TV, one of the biggest factor that it's still, the erosion is slightly less than what it could be is because of the sports programming on broadcast, on your traditional TV, even if not broadcast. You take that away, I mean, that thing is going to deteriorate even faster. For example, today, if you want to watch NFL football on Thursday, you can't watch it unless you have Prime subscription. Similarly, there are certain slots over the weekend where you need to have Paramount and other things, right? So the point there is the shift is taking place. Now let's look at what does that do to the players who does the measurement in this space. When they talk about measurement is simplistically saying who watches what and when, right? When it was a traditional TV, a program, Seinfeld used to come on Thursday previously at 8 o'clock, easier to measure, right? When it's digital, you do not know who's going to download what on what platform. Right? It could be your phone, video, through Xbox, or any of the other outputs. What measurement companies do is very valuable because that is the metric on which the ad buyers and the ad sellers they transact. That's the currency. So when you hear about a Super Bowl ad this weekend is going to go for 5, 6, 7 million, it's all based on who the viewership is, on that basis. It's a lot easier for the traditional. For digital, it's a lot more difficult. But what makes it even more difficult is when you have to bring both those things together and add a layer at the top on which both the buyers and sellers can transact. I mean, that's a huge order. It's very complex. It takes a while to build that. And not only build that, get it tested, get it adopted by the customers. That's a effort that is not easily appreciated in the public markets. And I think that is one of the bigger reasons for that take private.
So recap. Big driver of take privates is essentially the thesis is this asset is undervalued, that some of the factors are they may have varying earnings, which created some skepticism around.
Yeah, because there is not a lot of patience the public shareholders have.
So we got varying earnings, and then we have maybe missed some targets, earning
Yeah,
targets.
one or two, but as long as it doesn't shake its inherent value, it should still be valued there. But stock market reacts; it has a very short-term memory.
Could create some skepticism, and then maybe the overall sector is down.
Yeah,
Could be another factor. And then the why is when you're public, there's pretty intense quarterly accountability.
yeah, it is.
You got to hop on the earnings call and deal with the investor analyst there. And then second is the reason why too is if you're playing on a long-term strategic initiative, that it may make more sense to take the company private, execute on that strategy,
Correct.
and take it back public again. So I think that's a good example. And the one you sort of mentioned too is a lot of that nature of that business didn't fall well in the public eye as opposed it could be in private.
Yeah, and also anytime a company, the sponsors take company private, there are certain standard costs that you take out just to improve profitability. But just improving profitability by in itself is, in my view, not a sufficient condition to take it. There has to be a promise that you could do a lot more from a top line perspective, grow it. And in some cases, there are businesses that are too spread out, so bring back the focus. So that's why anytime a company gets taken private, there has to be a component that talks about the top line growth about it. Right? That's the whole reason when you think about a company that is a private company, when it's trying to go public, I don't know what the metric is these days. I remember there was a time when you have to have 6 consecutive quarters of growth, top line growth. That was, no matter how high your profitability is, if your top line is flat, you are not a great candidate to go public. That's why there are companies that can go public who have no profits. In fact, they might be burning through cash, but there is a promise of the growth of the top line, and that's very key.
Agree. Did you read Michael Dell's biography, Play Nice But Win?
No, I have not.
You got to read it. He's got such a good firsthand play-by-play of the take private of Dell. So it's a good story. But what I was curious, and by the way, if anybody listening to this has an in with Michael Dell and can get him on the podcast, reach out to me. We'll work something out. I would love to get him on and hear his side of the story. But I wanted to talk more about the mechanics of actually taking a company private like that, just because it's such a unique thing. You go through this huge event, ring the stock bell to go public, and here you are saying goodbye. We're divorcing the public market and we're going to go private. Can you tell me a little bit about what that deal process actually involves?
Yeah, so, I know a little bit about that one because there was a sponsor that was involved in that, was also involved in a company that I was at. And in fact, it almost could be said that Michael Dell pushed for that because for the same reasons, which is not go in front of the analyst every quarter, build something great, and then go out. And it actually is not, yes, you're absolutely right that when you go public, there's a lot of fanfare associated with it. But then when you go private, it doesn't mean that, it is the inverse of that. what it tells is actually it could be positive because think about this. But at the point when the company is taken private, right, there is someone who is seeing more value in that company than what it is trading at currently, right? So there is optimism in that. The way you actually squeeze and enhance that value is, by taking private. Yes, there's not physical ringing of the bell and those kind of things, but there's a lot more discipline. And now you have these sponsors who bring their own skills, network, and a whole lot of other benefits to the company to help them grow in their phase when they are in the private sphere. So I would not look at it as an inverse of like you did something good when you went private and when you went public, and it got reversed when you went private. Because think about this, when you went public, there was a lot of hope for that company, right? It grew. And let's say it grew, and eventually at some point, it stagnated or started coming down, which is where the sponsors will find value in it, right? So you have to look at not at the point where the company went public, it's where that company was just before it gets taken private and compare with that. And I think if you look at from that lens, it would look as the right move in a lot of cases.
The reality is there's usually a premium paid on the trading price to take a company private.
Yeah, but if a company is trading at a 60% discount to where it was trading last year, and you give 15-20% premium, you're still buying it at a discount to last year. So absolutely right, and that's why there is negotiation there, and a lot of times the companies say that no, we cannot support it. These kind of valuations in some cases, the deals don't go through.
Yeah, it's really interesting how those things get negotiated because it's not a flat, hey, it typically falls between this range. It's what you described. It's sort of there's a big picture thinking and a real perceived value with the shareholders.
And if there's a company that truly has lost its core growth driver, so even if it is, in that example, it is trading at a 60% discount to last year's stock price, if it is a falling knife where it's going to go 80% discount, 90% discount, they will be happy even to take at that price.
That's true.
So think about this. If there is a lot of people who think that the price could go further down and someone is ready to come and offer you a little bit of premium, people will jump on it. I mean, no one puts a gun to your head to actually agree to that price. The company knows where it is heading in that context. They make that determination. So yes, there is no hard formula for that. But every company in their own specific situation in their life cycle evaluate that. Take extreme cases. Bear Stearns. I used to be in banking at that time. Used to trade at around $100 or so. I was on my desk that day. It was, I think, Sunday evening. A lot of these transactions at that period happened on Saturday, Sunday over the weekend because they wanted to get it done before the markets opened on Monday. And we saw this thing flash which said, JP Morgan is buying it for $2 or something like that. I'm like, that must be a typo. But there was another article which actually spelled TWO. I'm like, wow. So think about this, a company that was just trading, how much value it lost. Eventually, it got sold for, I think, $10. They said that $2 was too less. They increased. But, in that case, $10 sounded at least something better than nothing, right? Now, I know that's an extreme example during the last massive crisis.
And then we had First Republic recently. It was
pretty exactly.
Similar.
Silicon Valley Bank, all those same things, right? There is no cookie cutter approach to it. It is what the management and the shareholders think where the value is, and what the offer is made by the sponsors.
Yeah, it's interesting game. You've worked on other unique deals in your experience. Can you give me some examples of some of those things?
Yeah, I mean, first of all, I'll say that every deal, regardless of the size of the deal, it has its own idiosyncrasies, right? Every deal is unique.
Yep.
So it could be a $500,000 to $25 billion. But I'll mention two deals. The first one is M&A deal, and the second one actually is an M&A deal, but the part that is interesting about it is the financing of that deal. So the first one is when I was at Avaya, the company was going through restructuring Chapter 11. Very quickly, you're going through Chapter 11, the company files with the bankruptcy judge. You have the day one hearing. Bankruptcy judge says, these are the expenses I approve. Everything else you cannot collect against the company. In addition to that, there is a DIP financing. It's called debtor in possession financing. Basically, it is cash that's enough for a company to run till it figures out its restructuring plan, right? So that's the standard Chapter 11 restructuring. I'm skipping all the other things that are not important. But in midst of that, if the company sells part or most of its assets, it's dictated by what's called a Section 363 sale. So we had networking assets which were not core to the company, fairly separable, which drew some interest from one of the buyers. So when a buyer comes in like that, that buyer becomes as a stalking horse.
Yep.
And a stalking horse essentially sets the floor for the valuation and also establishes the basic terms and conditions of your purchase agreement. So you get that, you go to the bankruptcy judge approves it. Now, one way M&A transaction in bankruptcy differs from your traditional. In a traditional, if the buyer agrees and the seller agrees, contingent upon getting any regulatory approvals, the deal happens. In this case, you at least have one more actor, which is the bankruptcy judge, because the whole process runs through that approval process. So the bankruptcy judge says, sure, this is good. Now you will open it for auction. So we make sure that the company is getting the best price for the asset you're selling. Now, unfortunately, everything becomes public. So there's another buyer who can come and say that, oh, the previous stalking horse put in $10, I'll put $11. There are provisions that you have to have certain level of incrementality. And if, for example, the stalking horse gets outbid, they get breakup fee and other things for their trouble to get the process through. The reason this was very interesting is not only learning about this process, but also the way people react. So think about this. The overall company is in a little bit of a fluid situation in Chapter 11, right? But an asset within that is potentially has an option of separating. So the people who work for that asset, they're excited for this transaction because they're leaving, call it a troubled home to a more stable home. But the people who are actually going to work on the transactions, like the M&A lead or those are the people who are in this troubled company. So it's very difficult or challenging to keep them motivated to help with this transaction, right? First of all, for most of these folks, whether it's HR, IT, finance, M&A is not their day job, right? They just help the function. For M&A deal team, it's their day job, but not for them. On top of that, you add this other factor when their own jobs are sort of not sure, and it becomes a little bit more challenging. So that was the other thing that I learned, how to manage and quarterback a very fluid situation like that. Now let me go back to the part which is the buyers. If there's a sophisticated buyer, they love situations like this to buy an asset out of bankruptcy. The reason is that these assets you get free and clear of any hair that you generally accept in other transactions. This is by virtue of how that bankruptcy sale works. And you can pick up, and also, you don't have to generally pay very high valuation. It's reasonable valuation. The downside of it is just like any other sale in traditional, when store is closing, right? They say you have 50% down, but you cannot return it. It's similar to that there is limitations on the reps, warranties, and escrow, right? And also, by the way, the consideration in almost all the cases is cash. You cannot, use equity or anything else.
No earnouts.
Yeah, there's a exception to that. If one of the creditors who is participating in the bankruptcy, they can use what's called as credit bidding. So because the company owes them the money, they said that use my credits and I could be a bidder for these assets as well. But outside of that, it's usually a cash-based transaction. So that's why it was a very new learning experience for me, and both from a technical perspective and as well as a human nature perspective. So that's one transaction.
What happened at the end? You carved out the business? Was it
It
successful?
was a great sale. It was, I can't give you the numbers, but it worked flawlessly. We separated those assets, and I was talking with someone else, one of my previous connections, and it's been many, many years since that happened. That was like 2017. There are still a lot of those people who moved with the transaction. They're still at the buyer. So which is a sort of metric that I use to say that, not everyone dispersed after a period of time. They're still there. So there was a good reason for doing that. So no, that transaction was a good transaction both for the buyer and the seller. Wow. So that, you don't have too many win-win situations, even though that's what everyone strives to do. But that was a very good case of that.
I like it. I'm going to start watching bankruptcy news for deals.
Yeah, listen, this is not something you want to build your resume on. It's good to know this, but the learnings that you get from a restructuring deal from the beginning to the end is it definitely adds to your skill set. So the second deal I was talking about when I was at Telecommunication Systems, amazing company, mid-market public company, no debt on balance sheet, had some cash, wanted to make a transformational acquisition. They did, of a company called Networks in Motion, NIM. To finance that transaction, we used equity, company's equity. We floated some more equity, went to 2 commercial banks, and then went to street to raise more funds. And the instrument that we used to raise funds from the street was a convert. And the reason we used convert was convert has a benefit that the interest rate is low. That's the benefit of it.
Yep.
But then why doesn't everyone use that as opposed to straight debt? Because if your company starts doing well and stock price doing well, the holders of that convert will convert into equity, and that will that'll definitely dilute your equity. So you give up a little bit, or you gain a little bit here on lower interest rate, but you have a potential of giving up on the equity dilution. There's an instrument that in addition to that, we bought on top of that just to manage that part of it, which is called a call spread. In a very simplistic language, call spread is 2 call options. You go long on a call option with a slower strike price, and you go short on a call option with the long strike price. That's why it's called call spread. The spread is between those 2 strike price. Without, again, going into details, the effect of that is that if your stock price crosses the first strike price, you effectually can eliminate the dilution that you get in that particular band. And that's important for companies like my company at that time, is because there was a psychological barrier for that company to cross the $10 mark in stock price. And I think it made a lot of sense there. Okay. Now, the convert that we bought was for $90 million. It was oversubscribed, so we exercised the green shoe option, which allows another 15%. So it was $103 million or something like that. But there are 2 aspects of this that were interesting to me. One was the banks told that it was going to cost, let's say, $10 million to buy this instrument. How do I, as a corporate dev person and a treasurer, know that that's the right price? So based on previous knowledge, I actually went and put those numbers, the strike price, volatility, duration, all that kind of stuff, in the Black-Scholes model, like a very simple off the back of the envelope calculation, and I was able to get something very close to what they were charging for that. But the more interesting part is the accounting treatment of it, right? there is a provision which says that if what you buy, it would only be deemed derivative if it is mimics the underlying security, in which in case was a convert, very closely. Otherwise, it would be deemed as a speculative, and the accounting treatment for that is very different. There's a provision in SEC accounting called ASC, I think 815 or 805, I forgot. It's been a long time. But the point is, the whole accounting of that was very interesting, and you had to measure those on a quarterly basis. Again, a new muscle that I had not ever used before, I developed as part of that. That was a good transaction. We had a lot of explaining to do because it was a public company, to the sell side analyst, why we were going with this instrument, why not. And since I was also leading the corporate development part of it, it was all integral to what I was doing. Phenomenal experience. I had a great boss at the company, so I thank him for giving me an opportunity to experience something like this. So I would say those are like the two transactions, not because they were the biggest transactions, like I've done much bigger transactions, but they were unique, and you don't get to do those on a regular basis.
Creative, interesting, complex.
That one was very complex because it required you knowing about just accounting for convert, and then call spread, and then how do you value it? How do you make sure that period to period you are not missing something? So there was, there was a bit of learning in that process. So that's the part I liked about it. There was a lot of learning.
Should have mentioned the bank accounts in the Cayman Islands to get the investment analysts excited there.
Yeah. Oh, it was a good transaction.
Can you teach me? And I don't know, this is like a whole podcast interview of itself, but about just like negotiating and structure. And I'm curious about this as a founder of a business that's dying to do deals. Not quite ready there. We got good organic growth, but I feel like it is early in that life stage of doing deals. You want to be savvy with capital. You want to reserve cash.
Sure.
So you're more interested in structures that earnouts, owner financing, things like that. And I want to learn from your experience. And like, what are some of the approaches you've seen to really structure that in a way to preserve cash for a company that's more on the emerging side or really sensitive in how they invest cash?
Yeah. So more than seller financing, I worked on a few deals when I was in banking. But in corporate development, I've used a lot of earnouts. Earnout is essentially contingent consideration, right? If you meet the metrics, then you get paid. Otherwise, you don't get paid, right? And I've also used delayed consideration, which means you will get paid, but not at the time of the close of the deal or over a period of time, but that's not tied to any metric, right? So those are the ways to preserve the cash on closing. The other thing is, the way I've done is, for example, you use escrow to backstop the basic reps and warranties. I push for that escrow not to leave the company to a third party where it'll sit. I just keep it with the company and pay that much less in consideration. And if there is nothing to charge against at the end of that escrow period, so let's say those basic reps and warranties, normally I shoot for 2 years. At the end of 2 years, there was no violation of any of those, and I have to pay them. And I pay it from the company's balance sheet. So that way, I managed to keep and use that cash for 2 years as opposed to have it parked at a third party who would automatically release unless I raise an objection to the breach of any of those reps and warranties. So, those are the ways. Now, especially as opposed...
Are you releasing that escrow or are you keeping the escrow?
No. It's not the escrow, right? At that point, it's what it has become as a hold back. So I'm holding it back. If it's an escrow going to a third party, right? So there's a third neutral party, whether it's a bank or something else, that money has already left your company.
Right.
So it doesn't do me any good. I can't use that money. It's just sitting there. And the best I can do is if there's a breach of, rep or warranty, I could claim against that. But that money has already left. And even there, that's a high bar. You just can't say that, you want to do. And more importantly, at that point, you're going against some of the people who are working for you now, right? You have to be mindful of those things. So until unless there is something that really came off the rails, in which case, absolutely, you should assert your claim as strongly as possible. But outside of that, I think I like to hold the money, use it. It doesn't leave the company. And also, I don't have to prove to a third party, to the escrow, why they should not release if I have a claim. I can work that directly with the seller. Why I'm not releasing the full or not paying the whole thing. And then coming back to there are some cases, so escrow, right? So escrow, this genesis of escrow was at a time when there was a stark difference in the expectations of the buyers and the sellers, right? And it was a way to bridge that gap. As long as the size of the escrow is not significant, massively, like it's not too big compared to the underlying consideration, then I think it makes a lot of sense. But if you're paying, call it $1 million in cash consideration and your escrow is $4 million, I mean, that's a speculative deal. In which case, it's almost like you're telling the other person, I don't believe in anything that you do. You have to prove, your whole business case to me. Escrow makes sense. For example, I remember in one deal, we were paying all cash, but I made a condition that before we actually signed the deal, I wanted to speak with these 3 retailers. They were able to make us speak with 2 of them. The third one, they could not make us, that couldn't happen in the time. And that was important because that retailer constituted a pretty decent amount of the revenue. So we refused to sign the deal, but we said, listen, we could do it. And it was actually in our interest to sign the deal quickly. But we will hold an escrow, and that was a significant, close to 25% to 25 to 30% of the escrow. We'll hold that as an escrow, as a earnout, and only when that retailer signs next year's contract will that gets released to you. It just so happens in that case, the retailer went with someone else, and we ended up not paying the escrow.
I like that.
But all that came up was because we insisted that we needed to speak with each of them pre-signing. We spoke with 2. Those 2 retailers said great things about this business. Insisted on 3. They said, oh, you spoke with 2. You got a good idea that we do a good job and this and that. I said, yes, I'm not doubting your capability. What I am trying to figure out is this third retailer, does he still want to go with you or is looking at someone else? Because in the business case, I'm assuming that revenue stream. And if that doesn't come, I as a corporate development person, but more importantly, the business sponsor who is backing this deal will be in a very hot seat and very quickly. So given that we had negotiated that, I mean, it helped us, avoid that embarrassing situation.
Yeah, it was played well. Especially you see these deals with that high customer concentration.
Yeah, like everyone takes hits, right? After you've done a bunch of deals, and I think I've done over 70, 80 deals by now, right? So you learn certain things. M&A by nature has become actually the process itself has become very structured. It's the same thing you follow. The variability comes with what actors that come into it. When I say actors, means what are the assets, who are the buyers, who are the sellers, all those kind of things, right? So,
how do I do like 100% financing or get the seller to take the whole deal on or not?
Yeah, I mean, so think about this. If there is a seller who is ready to do that, obviously that's a sign that it's a very desperate seller.
Yes.
And if there's a desperate seller, And if it's 100% financing, the question is that 100% financing contingent or not? If it is not contingent and they're financing you for a period of time, you would you should think that you will be on the hook for that. It's just that you're not paying for that now. Why is the seller agreeing to it? It's possible that there is no other buyer. They are desperate, which happens. And this is a better home for them. And they see promise by combining the capabilities of the two companies. It could be a whole lot of reasons. That's why specifics matter, right? But if someone is ready to sell your company all on deferred or contingent consideration, there has to be another reasoning, a very solid and diligenced reasoning why they are agreeing to that.
Do you ever convince sellers to sell?
Sorry, convince sellers to sell without any account of the any of these things, earnouts or anything, or just like a seller doesn't want to sell and I'm trying to convince them?
Yeah, I feel like there's influence on that of like making the decision to sell. Then there's an influence on how much you can get them to carry.
Yeah.
I want to learn the real art of deal making here.
Yeah. No. So again, I just want to make sure that I answer the exact question. So now we're talking about there's a seller who I'm going to call as a reluctant seller.
Yep.
And you are trying to convince that seller to sell.
Yes.
In this particular case, you're not talking at all about contingent consideration or
that comes next.
So I'm gonna dissociate that, right? So that we focus on just this one aspect. If you're doing that, whatever the valuation you're gonna get will be high, right? Because you've already exposed your cards, which is you're desperate to do that. Until unless you can convince the other side that they can realize higher value in the combination, right? In which case, you have to share with them the promise of the combination. I think that is the way to go about it. Because outside of that, the only way you're going to convince any seller to sell, any reluctant seller, I can ask, if you tell me that, hey, Baljit, this person doesn't want to sell, can make him sell. The easiest thing is throw a lot of money. Everyone is going to sell at some price point. Right. The point is at what point it stops making sense. So the way you provide the value to the seller instead of just cash up front is a promise for a greater future tomorrow.
Equity.
And in which case you'll have to share a lot of your cards too, right? So you have to share what you're doing. You have to convince the other side that, what Kison is doing actually has merit, and I see a potential, and I want to be on that bandwagon. I think that's a good way to do it.
Better together.
Yes.
Okay, so we get that ability to convince, and then maybe there's that portion of or take the equity. How about the other factors? And I'm wondering, in just deals where you have multiple, I don't know what you call it, tools, multiple tools that you're using, where you're using equity, earnout, debt financing. Have you run into that a lot where you're using a lot of combinations? Or pretty straightforward, cash and earnout?
Yeah. So first of all, I'm of the opinion that if you don't have to complicate the things, don't complicate the things for the sake of doing it. Because if you have all these four options that you said and you decide to avail that for a certain transaction, I mean, the overhead associated with managing that post-transaction is going to be a lot, right? Cash is the easiest part. It gets settled at the closing. But everything else has, you have to worry about how do you account for that in your books. So I'll give you an example. Earnout. This is where actually I learned a lot about controllership because I was playing that role as an associate controller at Telecommunication Systems, is that earnout, you show it as a liability on a balance sheet, right? Because at some point you have to give out that cash. Now, every quarter you have to market that if your earnout is for $10 million, and let's say the earnout could be paid anywhere from $0 to $10, okay, $0 to $10. The day you sign the deal, you're going to mark it as a liability of $10 on your balance sheet, okay? Now, if the business that you're tracking, you acquired, if it actually starts doing worse, you actually can next quarter or whenever the next marking period is, quarter end is, you can write it down from $10 to $8. That $2 runs as a profit through your P&L, so it actually benefits you. But the point is, you have to quarterly keep a track on those earnouts, right? It is extra work. So you have to account for all those things when you're trying to bring in other metrics other than just cash. Equity in the whole spectrum between cash, everything else, equity generally, pound for pound, is the most expensive way of financing. It is like if you do the EPS calculations, generally for a standard companies, that's the most expensive. So you should try not to use that. But if you're using it, use it wisely. Use it wisely so that the other party actually feels that they have a stake in the game, right? Because once you become an equity ownership, you want the company to succeed. Actually, we acquired a company. Oh, sorry, we made a minority investment in the company, but a significant amount, somewhere in the vicinity of $20 million. That company got sold to a third company. That company to which sold paid 80% in cash, 20% in equity. But because we were minority shareholders, we now hold the equity of that buyer with whom we had no direct dealings purely because of the way this transaction happened. And we had, for a period of time till, you could actually, there's a stamp that goes on the shares that come whether you can openly trade it or not on the stock exchange. So there's a 6-month period to take that sign off or the badge off those shares. So for that 6 months, we had to keep the shares of the third party with whom we had no other relationship of that kind. The point is, there is work associated with it. So before you just want to think about this as different toys and you want to have one of this, you better have a good reasoning why you want to pick which one you want to pick.
This is good. I feel like I'm teeing us up for a whole other conversation.
I each one of these things I'm mentioning to you, we could go into a lot of detail to look at the merits and the rationale for doing any of those things.
Okay, tell me what the craziest deal you've seen. Wait, what's the craziest thing you've seen in M&A?
Like as it relates to me, right? What I have experienced. I mean, I could tell about what others have seen. I could give you a couple of examples, right?
Sure.
So anytime, by the way, this happens in so many deals. As you're trending towards the deal signing and closing, the pressure builds up, right? You have to tie up all the loose ends. That's where you realize sometimes, oh, I forgot this. I should have done this before, right? So there are many of those. In our case, there was a simultaneous sign and close. The deal was in Europe. Everything was tied up. The next day was day one for the company, which means the comms plan, letting the sellers, employees know, our employee know, all that stuff was going to happen. But before that, we had to transfer the funds from US to Europe. Then it would go and get dispersed. At the last minute, of the three principals who were the beneficiaries, one of them, we didn't have a signature. It just so happens that the person was also a licensed pilot. So when we were trying to track him, he was actually flying a plane at that time. We actually thought, when you get desperate, all kinds of weird things start creeping up in your mind. So we thought, is there a way to reach into his cockpit? Someone can send a message into his cockpit because everything is hinging on this thing getting done. Obviously, some sensible person said that, no, let's not make it out to be more than it is. Eventually, the person got down. We got the signature. We did actually get delayed by a day, but it was no harm, no foul. But that was, one of those things. Another one was, it was deal got done. So all three, I've got many, but I'll give you another one. The deal got all tied up. As part of the process, just before you sign the deal, we have a practice of sending the whole deck once again back to the executive committee to get their final approval that yes, nothing has moved. What we told you before, it's still the same. And the biggest part that's included is the deal rationale, which in that particular case, we said that, the value that we are getting from this deal is 100 million, but we are only paying 30 million, right? I mean, that was all part of it. When that approval email was sent, there was, how if there's a name you have already sent to, it auto completes the email.
Yep.
It actually, by mistake, auto completed a name which was the seller's banker. So we ended up sending an internal draft to a seller's banker, which basically said, what a good a deal we are getting on this one.
Oh my God.
The minute we realized it, two things happened. Sent the email directly to the banker, not to open, and the banker didn't respond. In a very short period of time, our lawyer wrote a letter, which also went to that this is not meant for you. Do not open it. Do any of the stuff. The banker eventually got back to us and he said, yeah, I saw, I didn't know what it was. Like he downplayed it. He said, no, don't worry about it. I deleted it. All good. Now, I don't know if he looked at it or not, but I think for his own self-interest, I think he decided, if he did, he decided not to share that because think about this, if you share that with a seller and seller said that, they think this is worth, 3 times what we are, we should be asking something more. And if they did ask something more and came back to us, we would have walked away from the deal. And the banker probably realized that, and his fee was tied to the success of the deal. I think it was in a weird way, incentive bill for the banker not to look at this thing or, do something like that.
He did the right thing. I was surprised. I was waiting for the story to even get a twist here.
No. So here's the thing. You panic in those kind of moments, but the experience has taught me eventually things have a way of working out. They might get delayed a little bit. And I'll give you one transaction where we canceled the deal. Thursday was, remember, because when you go through this experience, you remember the days for some reason. Thursday everything was good. Monday we were going to sign the deal. It wasn't a simultaneous sign and close. It was signing and then there was a gap and then closing. Everything was good. There were, I think, 2 relatives. I don't think they were brothers, but there were 2 folks, founder, owners, co-owners. They were the primary beneficiaries of the deal consideration. Everything was going on well, all settled. One of them, who was the CEO, and this was a company that was outside of US, he sent an email saying that, hey, listen, all is good. I wanted to send you this. I wanted to convey how much value I contribute to this company, how much I can contribute to your company when we are together. As a result, my comp should be multiple factors of what it is. We took it to our CEO. They looked at it. We realized that since we would never be able to physically bring this company into the fold of our company because it was in a third country, that person would always have influence over the rest of the company. So if he's unhappy, it's going to be a bad situation. And the fact that he decided to bring it up at that moment, we decided to walk away from the from the deal.
Oh.
Literally 4 days after that, and they didn't have any banker. They hired a banker. The banker calls me and he says, listen, this is the reason you should always hire a banker because, he was trying to justify his thing. And also what the amazing thing he said that, listen, let's get this deal done. You already have the document all signed up. And I told him, once you lose that trust, it's difficult to build it. It is not a matter of documentation at this point. And we never did that deal. So.
Did the banker sell it for 10x more?
No, that to the extent I know, for the longest period, we were the most natural buyer of that business because we were a bigger company. In fact, there are some smaller companies, when they're building themselves up, they have one eye, they know who their buyer is going to be, and we were their natural buyer. And at least as long as I was tracking them, they were not sold. They might have been bought since then. So.
You got to have a banker, right? Always got to have the right banker.
Yeah, so
Maybe.
I mean, they add value in some cases. So I don't want to ever say that they don't. I do see the ones who actually do more brainstorming and strategic, analysis with you. They do. Some are purely procedural. They're just,
I will not get. There's some extremely good bankers. In fact, we got some
No.
really good ones down the street at
I know
PG.
I know some very good bankers with whom actually I have kept in touch over many years, and they definitely earned their keep. But yeah, this was a banker. When I'm talking about this banker, it was like a 2-person shop in and he called himself a banker, and he was like a financial advisor to those cousins or brothers.
Crazy
Yeah,
stuff.
yeah. I mean, the more people you talk, the more stories are there. There's more scars that you get as you go through these experiences, but nonetheless, they're all very valuable.
Baljit, this has been a great conversation. I appreciate you sharing your wisdom, helping me become a better M&A scientist. To those of you still with us, thanks for tuning in. Till next time, here's to the deal.
Thank you.